Hello, everybody. Welcome to today's episode of The Daily Dose. Today is Wednesday, September 21st, and it was a big day in the markets. The Fed hiked interest rates for a third consecutive time by 75 basis points. So if you like this type of content, be sure to subscribe on YouTube or follow us wherever you listen to podcasts. It would really mean a lot to me, and it would be the best way to keep up on this type of news and content if you enjoy it. Every day that the stock market is open, we will release a short video just like this one, and over the weekend we'll release our weekly wrap video, which goes a little bit more in depth and has some more commentary. So if you're interested in that, be sure to go back and listen or watch the first 11 episodes from the first 11 weeks. They're really great episodes. There's a lot of great information in them, but let's go ahead and get started with today's episode. So for an unprecedented third consecutive time today, the Federal Reserve raised the interest rates by 75 basis points. So what does that mean? It means the new range of the federal funds rate is going from 2.25 to 2.5% to 3% to 3.25%. This is its highest level since 2008, so we haven't seen the interest rates this high since after the global financial crisis. Stocks were all over the place. They were green. They went red right after the announcement. Then they shot back up green, and then they went back down red. So they were kind of all over the place. We mentioned yesterday that I was expecting stocks to go down once the news hit, even though that the market was expecting a 75, quote unquote, expecting a 75-point basis hike. The fact that it has now been realized is just inherently negative for stocks. So just the fact that it happened today is going to send down the market regardless, especially after we've had such low interest rates for a very long time. So I thought that this was interesting. Powell was stressing that his colleagues and I are strongly committed to bringing inflation back down to our 2% goal. So I kind of want to get into that a little bit because it would take a longer period of time than most people, I think, are realizing to get inflation back down to 2%. Inflation has basically stayed flat month over month the past 2 months. In August, it was up 0.1%. In July, it was flat. And even with that 0.1% increase over 2 months, we're still at 8.2% year over year. So even if we're flat from here on out, the interest rate will still be around the inflation rate will still be around 6.5% for the year, even if it's 0% for each month, the rest of the year. So if they really want to get inflation back down to their 2% goal, and if they do follow through with this, what most likely is going to happen is they're going to tighten too much, and we'll see some sort of disinflationary environment or deflationary environment where they accidentally go too far. And then they'll have to pivot quickly, which the way the markets work now is just inefficient in that way, where they tighten too hard, they loosen too much, they tighten too hard, and then the market cycles become faster, more extreme, and a lot of people end up losing money. But this is obviously a very big problem. They need to get inflation under control, but I'm just saying that I could definitely see that happening. But I don't think people realize how long it's going to take for the Fed to be this hawkish to get back down to that 2%. And I think that could really hurt the markets. Let's see here. So during the question and answer session, Powell reiterated that we are focused on getting inflation back down to 2%. We cannot fail to do that. I mean, if we were to fail to do that, that would be the thing that would be most painful for the people that we serve. So for now, that has to be our overarching focus. So, I mean, it's scary if you're a worker in a place where you could be laid off because of the economic environment that's most likely to follow from this. But I mean, it is the reality of our situation that the only way for us to get this under control is for them to tighten the economy hard. And that's going to hurt a lot of people. It's going to hurt a lot of working class people. But he's saying that their main focus is inflation, and that they're not going to be as worried about unemployment for now. So the Fed's latest interest rate hike comes as inflation continues to surprise to the upside, and the Fed continues to see inflation elevated this year. Officials see inflation rising 5.4% overall this year and end up 4.5% when excluding volatile food and energy prices. And the reality of the situation for actual people is you cannot exclude food and energy prices. People are hurting from these prices, and the reality is that inflation is probably a lot higher than whatever numbers they're pushing out to us. What people are feeling is a lot worse than what they're pushing out to us. So if you look at the inflation rate over the last 50 years, obviously we had this issue in the 70s. So what happened in the 70s and the 80s is they had this huge inflation problem. It started to come back down, and the Federal Reserve actually pivoted too quickly. They loosened the economy, and we had a resurgence in inflation. So what the Fed has been saying now, what Jerome Powell has been saying, is that they don't want to repeat this mistake. So even if inflation starts coming back down aggressively like this, look, they got back down to 5% from 12%, and they're like, hey, we got this under control. They loosened the economy, and then it went up to 14%. So what they're saying now is they need to get this all the way back down to 2% before they even consider pivoting. And I think that's going to take a long time. I think it could take at least a year. Fed Chair Powell also noted that a soft landing where the economy avoids a recession as interest rates increase will be very challenging and will depend on how quickly price pressures come down. He said, and I quote, "If we want to set ourselves up really light the way to another period of very strong labor market, we have to get inflation behind us," Powell told reporters. "I wish there was a painless way to do that. There isn't. What we need to do is get rates up to the point where we're putting meaningful downward pressure on inflation, and that's what we're doing," unquote. So again, he's really reiterating the point that it is going to hurt the labor market. It's going to hurt the working class, but he's arguing that this is too big of a problem to not defeat. And he does say that obviously that their goal is to have unemployment go back down once they get this under control, but they need to get this under control first. So the fact now that he's just addressing the pain that is to come, it's a little bit concerning, just because usually the Fed will try and make the situation seem better than it is, that they're going to protect people from pain. And I think they're just trying to reassure the market and everybody that, and the world, honestly, that they are taking this very, very seriously, and they're taking it very seriously. They're trying to get this under control, but just the fact that they're being so blunt about the pain that's to come, it's a little bit bleak for people that are in the working class and could lose their jobs, and they will still be feeling the effects of this, regardless if they get inflation under control. So let's get into the stock charts now. Sorry, I went a little bit longer than I normally do in these videos, but today was an important day, so I wanted to spend some time on it. So the S&P 500 is down 1.71% on the day. That's where it closed, and it basically did what we expected it to. So today, even when it surged, it came back up to the bottom of our zone around 38.90, and it sold off heavily from there. So we're sitting at 37.92, which, if you look at this line, this dotted line that I have across, again, I apologize to the podcast listeners, there is a little bit of support here, a little bit. Really, the main support we're going to get is when we come back down to this zone around 3,700 to the bottom from June, which was 36.33. That's an intraday bottom. But really, if we break through this zone, I mapped out the next kind of level of what maybe could be a resistance point. But in reality, when you zoom out, the market will use, and I wish I could show you during this bull market. But for example, if you look on this bull market from here all the way up, that's your channel line. And from here, all the way up, that's your trend line. And if you zoom out, the market will typically go into these longer cycles or trends where they'll just be bouncing from the channel line to the trend line over time until it breaks one way. And if we look here, that's what's been happening so far. So this is our trend line. This is our channel line. And it kind of just sways back and forth. So if we break through the lows in June, I would be expecting this channel line to get touched, regardless of what resistances we have on the way back down. Maybe it buys back up, like say we break through the lows, we hit this, we buy back up to the lows and then come back down. Even if that happens, I think the longer term trend, if we break through this point from June, would be to hit this channel line. I just think that makes the most sense technically. So if we look at Bitcoin, I mean, right now as we speak, as I record this video, it's moving downwards. It also was very volatile today, along with the stock market. It was red, then it was green, then it was red again. We're down about 2.35% on the day. It's trading at 18,500. Again, what I'm going to mention every single day until we move out of this range is 17.5 to 17.7 is our point of no return for Bitcoin. If we break through this level and we close below and we move lower, there's really nothing stopping it until you get to 9,000 to 12,000. And I do believe that's where a lot of whales, banks, institutions, Bitcoiners, people like me that don't have a ton of money, but we're just going to be putting money into Bitcoin when it gets down there. I just don't see it staying there for long. I can most definitely see it getting there. I think that's very likely at this point with the bearish pressure it's putting on this support, but I don't see it staying there for too long. I think there's going to be a ton of buyers if we get down there. There'll be extreme panic on the way down, but then I think when we get there, there's going to be too many buyers and it's not going to stay there for long. Usually in a market, especially a market as volatile as this one, you don't actually get the bottom for super long. It's another reason why I don't think this could be the bottom, because we've been in this range for like almost 4 months. And typically speaking, a market won't give you 4 months to get the bottom. So it's just something to keep an eye on. Obviously, this is still a very steep discount for Bitcoin. I've been investing in it for months, just putting more and more into it, but I do have some money stashed away in case it gets down to the 9,000 to 12,000 level to put into Bitcoin, because I think that'll be a pretty good level for it. So I'm going to wrap it up here. This is a little bit longer than normal. Again, today was an important day in the markets, so I wanted to make sure I gave you all the best quick video that I could. If you enjoy this type of content, it would mean a lot. And to support the channel, subscribe on YouTube, follow us where you listen to podcasts. It would really mean a lot to me. I've been doing this channel for a couple months now, but really just trying to get it going. So that would mean a lot. Be sure to stay tuned for episodes the rest of this week. If you haven't watched this weekend's episode or you haven't watched all of the weekly wrap videos, they're definitely not super time sensitive, so you can definitely go back and rewatch the first 11 episodes of the weekly wrap. There's a lot of great information in there. But other than that, thank you for listening today, and I will see you in the next one.